Economy's tipping over, inflation's tilting towards deflation, and the Fed's there'll be the major consensus out there. So, well, they can't ease with the ease they have in the past because of the inflation they created last time. So to me, that to me is the bearish scenario that markets are starting to price for. It's pricing for 50 basis points actually by December, we're pricing for 4.5%, and rates are going to go up above 5% in next week or 2 weeks. And to me, that's just not going to happen until markets force them to.
Hey guys, welcome back to Library of Wealth. Today we have Bloomberg's senior macro strategist Mike McGlone discussing the current state of the economy and his prediction for the next few months. McGlone says that there are classic indicators of contracting economic cycles happening right now. Given the rapid pace of interest rate hikes, the fastest since the late 70s and early 80s, and given the much speedier impact on both the financial and real economy, this could accelerate inflation, and a recession may arrive sooner rather than later. With the Fed tightening monetary policies, the next few months will be crucial to what the rest of the year will hold. Let's listen to this interview with Mike McGlone as he gives his market prediction for the second quarter of 2023 and how the Fed's next move will impact cryptocurrency and global financial markets. Before we dive in, don't forget to hit the like button and subscribe. It's a tremendous help for the growth of the channel and helps us bring you more content just like this.
I think the only thing that's going to stop them from raising, they're at 92% that they go 25 on the May 3rd meeting, is a pretty sharp correction in the stock market. And I still think that's the main problem that people are not figuring out yet. Even the debt crisis might not get resolved until the stock market makes it get resolved. It's just how these things are right now. So I got to meet with Dave Alteg of the Atlanta Fed last week, and he, I think he was surprised that when I told him, do you realize that the producer price index, it's only been around 75 years, it's falling at the fastest pace in the history of that index? And he kind of like gave me a ham. Now, he was very good. I really thought he was nuanced in the meeting, but he did point out they thought they handled this banking crisis well. I didn't say it, but my implication I get from is, because the stock market and the markets did okay with the response. So they didn't do much. It was the Treasury that did it. But the key things I'm pointing out right now is I have to warn our VIS listeners, need a little bit of a disclaimer, because my job is just to be a trader. I mean, I used to sit in those phones. I was a trader, and I spent my whole time trying to help people mitigate risk and make money. We didn't have a view about anything except to try to make money. And my view right now is I'm bearish almost everything. Bitcoin, Ethereum, stock market, except for long bonds and gold. And I have to say why, because same narrative. We bounced to really good levels. And the sense I'm getting in cryptos and doing all my research the worst is over. And I look at that as a trader. When you've got money on, and you sense everybody thinks the worst is over, yet there's a significant fundamental reasons for the worst not to be over. We haven't even started the recession. The Fed's still tightening, and cryptos are still, they've bounced, then you want to structure positions accordingly. So I think this 30,000 level in Bitcoin, 22,000 level in Ethereum are pretty serious. And when I can say things like fact that hedge fund positions, managed money net positions in bonds, 10s, and 5-year futures, this was my brethren. This is why I started the business. Shortest ever. Yes. And when you can say that, and there's only one case and example that was close, was 2018. That was right around bond yields, 10 years peaked around 3% and then dropped to next to zero. I look at that and was like, in that environment, you want to be selling stock market, buying treasuries, buying whatever they're short. I'm glad you knew that. And buying things like gold. And you don't want to be long any risk assets. Now, yes, it could be wrong in the short term, maybe just hedging, but this is an example of how I think technology has changed. I remember in the mornings when in the trading pits, first thing you'd go in the morning is you get the sheets, and you check out what positions were and what open interest did and stuff. Now it's all electronic, instantly. Now this data is once a week, but to me, it's just how it's migrating so fast. The sense I'm getting is most people are saying, "Oh, a dip." I'm like, these are significant bear markets in commodities. You're supposed to sell rallies, and everything is teetering to me on the stock market. And cryptos might be pointing out you're supposed to be doing that short term. Now, yes, you've heard this narrative from me before. It takes a while. I remember 2007 was a really tough year for me. I was trading them, but this is how I see everything at the moment now. And just the key thing I want to mention, leaving you with, is I think we're on the cusp of a significant deflationary cliff, and the only thing that's holding it up is the stock market. It has to stay higher.
McGlone points out the run on the bank that's happening right now, with deposits leaving U.S. banks at an unprecedented rate. He predicts that a credit contraction is inevitable, and raising interest rates is the best solution to the problem. However, he mentions that the Fed's stress test did not measure the duration risk of raising rates at the fastest pace in history.
I think the March bank issues are very much trees in the macro forest. And what was the main reason this happened? Because rates went up so fast and people didn't hedge properly. And the key point is rates are still going up. Yes, they're fixing each tree, but the forest is burning. And I think that's the macro is overwhelming. The fact that the Federal Reserve is still tightening. Yes, they might stop soon. And the rules of long and variable lags are just getting started. And then there's also going to always be opportunities, markets that lag that. So to me, some of that stuff is which watch the money that's leaving banks. It's just cannot expect a credit contraction without that. You kind of not expect a pretty significant pressure on the economy when you see that, and particularly the Fed tightening. And the key thing is the foundation for all this is where were risk assets before all this started? Remember, the stock market was one of the most expensive ever in many other measures. So I look at what's happening now as part of that slow moving trend. I see significant deflation in commodities, significant deflation in PPI, all the leading indicators, and the Fed still tightening. And the bank contractions is part of it. Now you look at things, okay, where's that going to matter? Let's look at housing. New homes under construction, peaking from the highest level ever. Data is only 50 years on that one. Home sales. Mortgage applications, I mean, this is clearly deflationary trends. And you look at the key thing that my colleague Anna Wong pointed out this morning was ECI and personal consumption expenditures will remain sticky. Those are the main inflation measures the Fed looks at, but that's the problem. They're still focusing on those things. So I look at it that this is things that I pointed out in 2007, and it's worse. Because back then, you actually had a stock market that wasn't as lofty compared to 10 years ago. The market still believes that the stock market trend is up. I think that's due for decoupling. The Fed stated it. Chairman David Attic said, we expect unemployment to go up and inflation go down. Now, it's virtually impossible to have unemployment trial from this level without a recession. It's just the way history's always worked when you have the lowest unemployment in 60 years. It always happened a few times. And then it's that sensation I think people are forgetting. And of course, he fully says we're on track for a soft landing. Priced in, boom, great. Everybody's priced in a soft landing. Where's your optionality? That we don't get a soft landing, that we get a normal reciprocal cycle from the biggest pump in liquidity that's dumping ever. Now, Bitcoin was such a big part of that. Cryptos were such a big part. And we both agree 22,000, 23,000 cryptos is ridiculous. A lot of those have to just get purged. Ethereum probably do okay. Bitcoin should be the best one. But here's a fact. On a one-year basis, gold's up about 5%. Stock market's down about 5%. Bitcoin's down about 30%. Commodities down about 30%, 20%. That's a trend. And I think that's going to continue.
McGlone predicts a period of deflation in everything except gold and potentially Bitcoin. He says this trend will continue until there is a significant lag from the Federal Reserve's monetary easing. After the Fed hiked interest rates by 25 basis points, this is now causing concern for risk assets like stocks and commodities as well. He mentions that central banks worldwide are still hiking, despite the world moving towards a recession, as seen in recent downgrades from the World Bank. He also predicts a future cleansing of the stock market to get rid of bad actors, just like we saw last year with crypto. What do you think about Mike McGlone's recent interview and market prediction for the second quarter of 2023? Comment down below. Thanks so much for watching. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.